Hello, everyone. Welcome back. Very nice to talk with our friend Dan Kemp of Morningstar Investments, Chief Research and Investment Officer. He joins us again to have about a 20-minute conversation about the current state of the U.S. stock market. Even we'll touch on some international stocks. How can we let the Brit not talk to us about some foreign securities as it applies to outside the U.S.? And of course, Dan, welcome back. Very nice to have you join us again.
Lou, it is great to be with you. Thanks for inviting me back. And yes, we'll definitely talk about some foreign securities along the way.
We will do it. Yes. Yeah, there's plenty to discuss. So recently I had a conversation with another investment firm. They shall remain nameless on this one, okay? But we did have a couple of conversations that clients immediately reached out and asked me to talk with you or the next person that we were talking about. And I let them know that it would be you, Dan, that we would talk about the reason that the S&P 500 isn't necessarily a Lou Tranquilli favorite. I won't put words in your mouth, but I will try to get you to agree with me, okay, if I can do so. Why the S&P 500 as an index is not my favorite market measurement, and also a little bit more about tariffs. So we are going to talk about that, and then do a bit of a revisit to our conversation to end 2024 about technology being so narrow and pushing markets wider, which is a kind of a continuation, isn't even kind of, it is a continuation of the conversation of why the S&P 500 isn't necessarily a personal favorite as it applies to indexes. So with that, why don't we just jump into it, because I've promised everyone that I'll keep these to 20 minutes or less. We'll give good information and we'll get everybody out of here. Instead of a TED Talk, it'll be a Lou Talk. We'll rename them, okay? And last time I did drop a name, and I might just do it again here, Dan, for you. That way I know who's listening. Anyway, let's get to it. So how about if we start with tariffs? Because it remains a topic of conversation, headline grabbing topic, and also I think fair concern from both business and consumer. It's just not something that we really have dealt with. We dealt with it during the first Trump administration. We heard the conversations that during the Biden administration, a lot of tariffs were still in place, but the headline wasn't quite as let's say, explosive. And now we're getting more of these headlines, and the question is, what do they mean? I guess there's a couple of questions in here. What does it mean to the stock market, the bond market, Dan, and also to consumers in general in the viewpoint of Morningstar?
Yeah, sure. Thanks, Lou. And I think as we look at tariffs, let's think about them in two different ways. Let's start thinking about them in terms of the impact on the economy, and then let's go on to think about the impact on investors, because that can be quite different. So when we think about the economy, I think everyone would agree, including the president, that tariffs are not good for the economy. They obviously raise prices for consumers in the short term, unless consumers change their behavior. Over the long term, the impact of tariffs is much more difficult to predict. If it spurs the local economy and everyone brings their manufacturing back into the US, then it could have a boost, and that seems to be what the president's aiming for. But equally, it could just lead to a spiral of higher inflation and lower growth as countries around the world retaliate, and tariffs become a much bigger challenge than they've been in the past. So they are a high risk strategy. We'll leave others to decide whether that risk is worthwhile or not, and whether the balance of probabilities in favor of the US through tariffs are a good thing or not. And that gets rapidly into questions of politics and away from economics. But nevertheless, over the short term, they increase the risk of inflation and also increase the risk of slower growth. And that's what we saw hinted at by by Chair Jerome Powell following the FOMC announcement of interest rates last week. So from an economic perspective, they are not good for the global economy in the short term. The long-term effects are more difficult to describe at this stage. The second thing, though, is that we have no idea whether there'll be any tariffs or what size those tariffs will be, because quite plainly, they're also part of the president's negotiating strategy with other countries. We've seen tariffs delayed and changed and adapted over the last few months of this presidency. And so it's very, very difficult to really say what the tariffs are going to be, even more difficult to say what their short-term effect is going to be if they're implemented, and then impossible to say what their long-term effect would be. And so that's putting a lot of uncertainty in the minds of investors. And that means you may end up with an outcome that's much better than people are worrying about, or much worse than they're thinking about at the moment. So what's happened as we've got into this tariff negotiation is there's been a much broader range of possible outcomes that we have to contend with as investors. And so that brings us on to the impact on the stock market and asset prices more generally. And so the first thing to remember is that asset prices, stock markets, tend to react to the available news that's around the market at the moment. And someone might say, well, we've had a lot of falls in the stock market over the last couple of months. Does that reflect concerns about tariffs? Well, not necessarily. Tariffs have certainly been in people's minds, but we would have expected those very expensive technology-driven companies that we've been talking about for quite a long time to fall in price. And so that's not unusual. What we've seen in the markets is not unusual. It's a normal rotation. We've also seen other markets that are better priced, other parts of the U.S. market do better. And so it's not necessary that tariffs are being fully discounted in the price. And so from here we could have a range of outcomes. But the most dangerous thing someone can do is decide what they believe about tariffs and how that's going to impact stock prices from here. That type of prediction tends to get you in all sorts of trouble, and quite often is just naturally aligned with your politics as well. So you can come into it with a political view that drives your economic view, that drives your market view, and that really leads us to put far too much emphasis on one possible outcome and forget about the full range of other outcomes that are available. Now, I've talked for ages, so I'm going to take a breath there and let you jump in.
Come up for air, but well done. No, you wrapped that all together beautifully. I'm going to push you all the way back to the start of the conversation about, we'll say, the push and the pull of tariffs between the current administration and the Federal Reserve. So the timing of this was an unintended excellent consequence. We spoke with the previous firm after Donald Trump stated that a recession was possible. Just after that, we had that conversation. Now we're just after the rebuttal, if you will, by the Federal Reserve and Chairman Powell, as you mentioned. I mentioned in that conversation, I'll mention it again. We are witnessing an out in the open fight between the administration and the Federal Reserve. Now, the old saying in investing is don't fight the Fed. And try as they might from an administration standpoint, fighting the Fed is quite a task, even for, let's say, those elected, because of the fact the Fed needs to look at the data and needs to give us some kind of, or they don't even really need to, but they do give us some kind of guidance forward that rather than a prediction, we can sit down and say, let's prepare for these outcomes. So I'm going back to the beginning, talking about the fight, because then we'll get right after that, the tariffs part of it. I've had multiple comments from clients asking the question, and to ask of you and others, well, if inflation goes up and the prices go up, it collapses economic activity, the stock market goes down, and that leads to what you just finished with, which is, again, a prediction and one possible outcome. What's the other side of that outcome, Dan? Is there another side? You said it's impossible to know long term. So if you could answer, what's the other possible outcome, and what is long term in your mind as it applies to tariffs? What is that kind of time frame?
Yeah, sure, Lou. Well, listen, I'll deal with the second point first, because it seems to be the most obvious that when we think about long term, we think about the period of this presidency, because of course that's when the president has control over trade policy, over tariffs. What's interesting, of course, is that when we had the move from President Trump to President Biden last time, then President Biden didn't change much of that trade policy and left many of those tariffs in place that President Trump had put in on China in his previous administration. But a number of companies were successful in getting around those tariffs by routing goods through other countries, changing supply chains and that sort of thing. So whenever you create a big financial incentive to get around a rule, then people find ways of doing it. And that's why it's so important to not assume that whatever policy is currently being enacted will have the desired effect, or even in some cases any effect at all. And so that's why it's really important not to put too much weight on a tariff view leading through to an economic view and a market view. The other side of that, though, as you said, is what are the other possible outcomes that we can be dealing with here? Well, that meeting, that press conference that Fed Chair Powell hosted last Wednesday was absolutely extraordinary because when challenged on the Fed's forecast for future interest rates, he virtually threw up his hands and said, well, what else could we predict? He just doesn't know. The Fed officials just don't know because they don't know whether tariffs will be implemented, to what extent they'll be implemented, and what the impact of that will be on inflation and growth. And so I think the first thing we should draw from this is if the chair of the Federal Reserve can't come up with a good prediction that's different from his previous one because he just doesn't know, then we really shouldn't be trying to predict what's going to happen next. But nevertheless, there are various courses that are open that don't just lead to high inflation and lower growth. As I said, one thing could be a change of negotiating tactic. Another could be a change in the value of the dollar that changes prices. Third could be a change in the sentiment of investors. So there's a whole range of possible outcomes aside from the one that immediately grips us of high inflation and lower growth when we hear about tariffs. There's lots of other ways that this could play out, and that's why, as I say, we shouldn't anchor on any one of them too closely. The key thing when managing a portfolio through this, or even more so in your position of running an end client's portfolio, which has lots of different philosophies of running money within it, is to make sure that the portfolio is robust, that it can deal with this range of possible outcomes and isn't just programmed to do well in one particular environment. So a lot of our time as portfolio managers at the moment, I'm sure this is true of the other portfolio managers you deal with as well, is just trying to think about that range of possible outcomes and how do we prepare the portfolio for the worst outcome, or indeed to capture the best outcome as well. And so that is a very uncertain time. But Lou, there's a phrase that I know that you've used in the past. So I'm going to steal just a moment here, which is it's much better to prepare than to predict. That's really what all investors are trying to do at the moment. And your end clients, of course, are trying to do the same thing as well.
Yes. Well, thank you for that bit of an advertisement there, Dan, and I will accept it. Okay. But this is not advertising for compliance sake. This is a conversation about open-ended outcomes. So there, I worked in the compliance part of that. So we'll get to the why not the S&P 500 after this next section, we'll call it, of conversation. This is in no form or fashion a victory lap because you and I both know with plenty of experience under our belts that if we try to take a victory lap as it applies to the preparation on the stock market, it will give us a whooping that we will deserve if we take. However, I do have to mention at the end of last year, we talked about technology and its dominance over the valuation of the S&P 500. I want everybody to hear me emphasize valuation because that'll be part of our discussion about the S&P 500 as a market index we rely so closely, so deeply on. The market has, let's say, broadened as we talked about at the end of 2024. So we went from narrow in technology to broad, and now we're seeing bumpy. Is this a natural course? Is it political? Is it tariff related? Is it just a natural part of the market? We discussed it at the end of last year. I think we're seeing it come about right now. We're seeing investment outside the U.S., which we had talked about being more of a value depending on where you were looking at that point. Is it still looking like a value outside the U.S.? And within the U.S., are we seeing some value in other places outside of technology that Morningstar is keen to invest in?
Yeah, Lou, absolutely. Never, ever take a victory lap because investment is never ending. And the moment you become complacent, as you say, that's when you get a whooping. So we don't be complacent. But what we have to remember is that markets move in cycles, that investor sentiment moves in cycles as well. And when investor sentiment becomes very extreme and very focused on one particular area of the market, then what's always happened in the past is that it tends to broaden out and sentiment changes, investor enthusiasm change, and you get other parts of the market that have been left behind suddenly look very attractive again. And that's exactly what's happened. Now, what marks that transition from the old state to the new state is normally some kind of catalyst. And a lot of people waste a lot of time trying to predict what that catalyst will be, and very seldom do they get it right, and certainly never twice. That catalysts only tend to be seen in hindsight. And so, of course, if you were investing in technology, so that incredible run up to the end of the year on that, and the narrative would have been there was on anticipation of that change in government and the growth in AI, then you wouldn't have seen that change happening so quickly over the last month or so. So never waste time thinking about catalysts, but look for other opportunities outside the current enthusiasms of clients. And that's where we saw, as you say, there's great value opportunities outside the US, the UK market. That's not biased. That's where the global Morningstar business has seen value recently. The German market, Chinese equities, other Korean equities, Mexican equities, all these other parts of the world which were getting left behind as investment was more and more concentrated in the US technology sector. So what we've seen, of course, is that many of those markets and those stocks have done much better this year than US equities, and particularly those large cap technology stocks. And we've seen some form of rebalancing, which is entirely normal, and I would argue would happen anyway, regardless of the current political situation. It's just that this was the catalyst for it this time. So we've seen that rebalancing. There's still good value in those markets. They typically still don't look overvalued. In contrast, the US market is looking a little bit better value. It's a long way from being cheap, and so we're not in a situation at the moment where we're saying, dump your foreign stocks and rush back into the US market or US technology stocks in particular. They look less expensive than they did, but when sentiment changes, then you can get a big move back in the other direction. So while we could see a reversal again, we would say there's still more opportunities outside the US than there is inside. But if those great US companies, those great US technology companies things continue to get cheaper, then of course there's going to be great opportunities for long-term investors there. So at the moment, I think we're encouraging most investors to sit on their hands rather than making big decisions. It's a very dangerous time to making big decisions, but remain focused on that long-term goal of trying to buy great companies at below their fair values. And we're seeing more of that outside the US at the moment.
Well, I think, and this is purely out of memory, so correct me if I'm wrong, you had mentioned it at least a year ago, maybe even longer. There's a difference between a discount, which we may be seeing a bit of a discount, and a sale. And they're not on sale yet, but they are on a discount. So if you're long-term, the discount can work for you. It would be nice to get them on sale, but in order to do so, we're going to have to experience a bit more pain in the U.S. stock market. So diversification and all the things that we talk about all of the time really do come into play. And I genuinely appreciate your comment about using different theories in client portfolios. I try to do so as often as I can for those clients that's applicable to. So with just a couple of minutes, let's talk about the S&P 500, because, for me, I say things that I mean, and I mean the S&P 500 is my least favorite index that is quoted every single day. And what a lot of people don't realize is that S&P is Standard & Poor's. It's 500 securities, and it's actually 503 securities that are currently in the S&P 500 index. So the S&P 500 is really an advertisement on your news every night. Standard & Poor's licenses their name to investment firms to use. I mean, there are others out there. There's the Bloomberg 500. There's Reuters 500. Give me another one. I'm trying to think of one of the, there's, there are any number. Yeah, Vanguard's 500. They all have it available. So anyway, but S&P has done the best job, let's say, of capturing the market interest. And at one point, which that point was in the mid 50s, when the S&P 500 originally was introduced, it was a very applicable index because of the fact there were not 12 or 13,000 securities as there are currently. So first problem I have with the S&P 500 is it's 500 in a universe of roughly 13,000 securities at this point. That is a small percentage. Okay. Now, I understand the market capitalization. However, that market capitalization leads to what we're talking about right now. My second issue with the S&P 500, it can become terribly out of weight. And as we saw with technology, 7 securities out of 503 securities made up a value of 33% at one point during 2024. And could have even touched 36%. I do have to double check that number, but I want to really illustrate that. It means if you had $100, but 503 stocks, only 7 of them made up 33 of those dollars. That's risk. That's real risk. And this just happens to be the technology sector that provided that risk. But in the past, it's been the energy sector, it has been the materials sector, the healthcare sector. Their valuations have pushed up. So those are my 2 big, let's call it, hobby horses that I'm on. All right, to use the English term, that the S&P 500 is such an inaccurate index because it's 500 out of many thousands, and it can become terribly out of balance if one specific industry becomes very valuable. Do you have anything to add to that, Dan?
Yeah, thanks, Lou. So first of all, I'm going to declare an interest because Morningstar has a big index business. So we license our indexes, and so I am not going to rubbish another index provider. But what I would say is you're absolutely right that particularly with the US, then there's been a concentration issue for certainly the last few years. has, and that's been writ large over the last year or so, and we can see the impact over the last few months. And so this is an issue that other markets in the world have dealt with, smaller markets, more concentrated markets, more naturally concentrated markets for a long time. And we outside the US always looked at the US market indexes as a much better measure of stock market performance, because traditionally it was much more diversified. And so what we've seen over the last few years is really two things happen. One is that index and others like it have become very concentrated, as you said, in a small number of companies. And second, of course, those indexes really only cover the public markets, so stocks that are traded on stock exchanges. Now, that seems obvious until you remember that so many of the largest, fastest growing, most interesting companies these days are in private hands. They're not listed on the stock market. So I would argue that market indexes in general are becoming a less good indicator of whether an investment manager is doing a good job. Ultimately, the best indicator of whether a manager is doing a good job is whether they're helping you reach their goals, whether they are getting you to the place you want to be, that financial freedom, that retirement, whatever you're aiming for. That is ultimately the benchmark. What we found is, because everyone else has different separate goals and individual goals, that the benchmarks, market benchmarks, indexes, as you mentioned, tend to be a good general benchmark. But let's not get carried away that they are the be-all and end-all of what investment is about. Investment is about putting your money to work in great companies and benefiting from those returns in years to come. And there's so many more opportunities, as you said, Lou, not just outside the US I've been talking about, but deep within the US, particularly smaller companies that get lost these days because of that focus, not just on that big index, but just those top 7 companies within that index.
Well, Dan, a couple of things in listening to you answer. Nicely done covering for Morningstar. Okay, protect the brand, no problem. Okay, we respect that and appreciate it. And you actually touched on a part of it that I left out of my first two, so let's make it the third. And this is part of it. The argument, and it's an argument. Indexing is better than active money management. Yes, that is true sometimes. And sometimes active money management is better than indexing. Why try to predict those times? Prepare for both. We have methods of operation that will allow us to participate in market growth through an index, the S&P 500, pick any one that you'd like, or when things are a little more volatile or need more of a hand in them to make selections, stock selection, more active management, well, be a part of that as well. And that's part of what brought you and I together in conversation is the fact that I try to use Morningstar and some others for client accounts because each one has a different philosophy. So we'll save that for the next time. Dan Kemp, Chief Research and Investment Officer, Morningstar Investments. Thank you so much for just over 20 minutes. We had to go a little bit longer because it's just so worth doing. So really appreciate your time. Always, always, always. So you'll come back and do it again?
I will certainly do that, Louis. An absolute pleasure as ever.
All right. Thank you so much. All right. Thanks, everybody, for watching. Questions, comments, send me messages. I always love hearing from you.